Hey, everybody, welcome back. Hope everybody's having a good week. Hope everybody's had an opportunity to look through some of the things we talked about last week. Glad y'all are joining us here tonight. What we're going to talk about today is debt myths and credit health. Kind of go hand in hand a little bit. But just a real quick review as we do for each week. Last week we talked about getting rid of debt. We talked about the debt snowball method, and we talked about the avalanche method and why the debt snowball is much better for you. If you haven't already, if you want to review, you can go. If you haven't seen it, you can go out to the Facebook group page and look at the replay. There's also in the guide section posted a document out there about reducing debt, so you can take a look at that as well. You can always find the replays on our Facebook group page, and you can also find them on my RetireWise YouTube channel as well. Just launched that, so we're going to start putting some content out there as well, in addition to what we're doing here on the Facebook group lives. So anyway, today we're going to talk about the debt myths to kind of wrap up the debt and talk about credit health. And then I'll tell you what we'll be talking about next week. But I like to always revisit, our treasure target and our 4-H's. So let me go over here real quick, just to remind everybody, what we're seeking and what we're moving to achieve to. So experience financial freedom. That's our target, right? So we're going to be working our way around these different circles and all these different 4 quadrants. And working our way down all these 3 different levels. So we're still kind of in the O section here. So last week we talked about the repair credit. We're going to talk a little bit more about some of the debt and how to utilize debt, a little bit later on. But as we go through the group, we're going to start talking about all these different areas. Hit me up too. Send me some messages. Let me know what topics you guys are eager to learn about. Because we're definitely going to get into all those things I listed on the about section of the group. We're going to get to all that stuff. We're going to get to investments. We're going to get to the banking stuff. We're going to get to retirement. We're going to get to the insurances and some of the juicy stuff. But you got to set that core foundational principle. So just keep in mind, it's a process, it's a step, and we're trying to get to that middle core here, experience financial freedom. We need to set that up for success for you. And then the other piece is, if you haven't done this already, a couple of weeks ago, we did the 4-H's of financial wisdom. This document is out there as well, also on the guide section. Just tells you a little bit about it, and then you go down and you can fill it out, do your own self-assessment, be honest with yourself. If you have questions about it, please hit me up, not a problem. Today, we're going to be kind of still in the stewardship side, because that's about the debt as well as your credit health scores, right? And credit healthiness. And then also still down here onto the avoid debt. So let's dive in. Let's talk about the debt myths and credit health. So this document that I'm going to be scrolling through here today, tonight it's going to be back. It's going to be out there on the guide section as well. So feel free to go out there and download it and have a copy for yourself. Give a little inside scoop. All this stuff that we're going over, we're going to be kind of building it up, and you can download all these separately. They'll be in the guide section. There is an overall kind of faith and finances document that we're going to make available to everybody. May not post it in the Facebook group itself, but I'll tell you how to get it. That will be kind of toward the end of all these sessions before we start into the next topics. There's some kind of cool stuff in there. It blends in what we're talking about, but it also has a lot of biblical concepts. And one of the sessions we're going to go through some of the 9 core principles that the Bible says about money. And the principles are pretty varied, and it goes into expansions from there. So then we'll do that in a couple of weeks. All right, so debt myths. We talked about debt snowball. We talked about getting rid of debt, but there are some debt myths out there. Just like we say here, the stories of Loch Ness monster. They're all myths, right? However, sorry if you believe in that. Let's just go down. There's 15 typical myths that we hear about debt. I'm going to go through these relatively fast just for the sake of time tonight. But like I said, this document's going to be out there. You can certainly review it. There's a lot more content on this document than what we're just going to cover here tonight. And then after this, we're going to cover the credit healthiness real quick tonight as well. So the first one, myth: once you marry, you're responsible for your spouse's debt. Many couples, you're paying down the debt jointly once you get together. However, if you have debt that's separate, technically and legally, that's separate unless you combine them into joint accounts. So no, you're not responsible for your spouse's debt prior to marriage. Myth number 2: credit cards from retailers are a good deal. Absolutely not. I kind of talked about that a little bit the other week, and how they market you and throw all these good deals at you and say, hey, get one of our cards, get a discount. Yeah, you get a discount one time, and that's it. And then their interest rates are astronomical, and they tend to have a pretty bad negative effect on your credit as well. do not go after those credit cards on the store credit cards, all those offers they give you. I'm going to touch on that a little bit more when we talked about credit health here in just a minute. Stay away from those retail credit cards. Like I said, I want to get you down to 1 as it is. Third myth, you looked it up, so you know your credit score. There's a lot of different ways to get your credit score. And there's different websites. I'm going to show you those here in a sec. There's a ton of different, dozens of different ways to get your credit score. Just because you get it from one place doesn't mean it's the same everywhere. There are probably over 60 different variations of credit score, so they'll probably be pretty close, but they won't be exactly. And you have to monitor all of them, or at least go through not all 60, but the major ones. So if there's a wrong piece of information on one, it may be correct on one and not the other. We'll talk about that here in just a second as well. Myth 4, closing unused lines of credit or lowering your credit limits will boost your credit score. That's not necessarily correct. Now, if you're an undisciplined spender, then lowering your total debt load, yes, that helps you because you're not spending the money. But the FICO scores and general credit scores take into account when you open each line of credit, right? The goal is, like I said earlier, is to get you down to 1, but you want to be strategic in that as well. You want to keep open the one that for you, if you have a rewards card or something like that that's advantageous, take a look at that. But then from there, you also want to look at the oldest one because the age of your credit definitely has an impact on your credit score. We'll talk about that as well in credit health. Paying off debts will instantly repair your credit. No, well, paying off your debts is fantastic and it will eventually help your credit. It's not an overnight thing, it's a process. And if you have negative information on your credit report from old debts, it takes 7 to 10 years for that to roll off. Myth 6, checking my credit report will lower my credit score. Absolutely not. There's different kind of credits pools out there. If I'm a lender and I'm trying to lend you money, it's called a hard credit pool, and it shows that I'm applying for credit. If you pull it yourself through all these different methods, how you can pull it, that's a soft one. And actually, if it's from the person itself, it has no effect on your credit score whatsoever. Myth number 7, credit repair services can fix your credit score. False. If you hear that out there, it's a flat out lie. They cannot, no one has authority or capability of going in and fixing your credit. It just can't happen. There's methodologies to go about it. We're going to be talking about some of these throughout this, these different Facebook Live sessions. One of them is paying down your debt. We're going to talk about things that negatively affect your credit here in just a second. You can do all this stuff on your own. What those credit repair services do is just kind of guide you, kind of things that we're going over here. They guide you, but they cannot. There's no magic pill that cannot magically fix your credit. That's based off of your credit history and behavior. Myth 8, divorce decree will separate joint accounts. That's not true either. You have to go to each creditor and see if you can break them out into individual accounts. Most creditors aren't willing to do that. Once they got multiple people on the hook, they like to keep multiple people on the hook. A lot of times way out of that is you have to actually close the account and go open up individual accounts. But that can hurt you as well on your credit score. Like we talked about, the older accounts, should stay out there. But so in the event of divorce decrees, then you're still responsible. And the decrees itself normally don't separate them out. You got to work with your lenders on that. It's okay to make minimum payments on debt. All right, so it's okay to make minimum payments on debt, and that's what the credit institute or the lenders want you to do, because that means you're paying more interest. So technically, it's okay, but those interest rates are going to pile up. You could have a $5,000, loan balance on your credit card. It could take you 30 years to pay that thing off, with the minimum payment. So going back to the snowball method that we talked about early and paying down that debt. So while it's technically okay, it's not best practices, and you're going to end up paying an astronomical amount in fees or interest and fees. 10, all debt is bad and it only hurts you. So we talked a little bit about that last week. I'm going to touch on that more in coming weeks. Installment loans, meaning personal loans, the retailer credit cards themselves, all that, yes, that eventually will hurt you. Mortgages, some other types of loans do not really factor into bad debt. So not all debt is bad debt. You have to have a credit file, right? If you have no credit, then there's ways to work your way up to establishing a credit by doing different accounts. It's not by going wild and opening up tons of accounts. So in general, debt is, disadvantage to you because most people, have hard times controlling it. But you want to have enough on open credit till you have a credit file so you can get to the loans like for mortgages when you need it. We're going to talk a little bit more about that in the coming weeks. Myth 11, you might have a large amount of debt. Your only option is bankruptcy. Absolutely not. Bankruptcy is the last straw, the last thing you want to do. There are things you can do to go through and pay down your debts, like we talked about, the debt snowball. There are things like debt settlement, and there's some organizations, there's even some nonprofit, there's some Christian nonprofits that will help you do debt settlement. But that should be the second, next to the last option for you. You should try to do it on your own. Counsel with someone. I can help you with that kind of stuff. Credit counselors can help you with that kind of stuff of how to go about tackling your debt the proper way to avoid bankruptcy. Obviously, there's going to be times where it's unavoidable. There's things that stack up, but you want to look at all options first. Bankruptcies will stay with you, for 7 to 10 years, depending on what kind of bankruptcy it is, and it takes you a long time to dig out of that. There is debt settlement agencies that will help you consolidate debt into debt consolidation. They work with your creditors and come up with different terms. That also, though, negatively affects your credit because that's adjusting the original terms. The creditor is taking on more responsibility, and that they'll actually put a note on your credit file that you're in debt settlement. Myth 12, bankruptcy hurts a credit score so much that you will never be approved for credit again. No, that's false. While it's very, very bad, we talked about it just a second ago, 7 to 10 years it stays out there. So it's going to take you a minute to roll off of that. Want to avoid bankruptcy at all costs, but you can recover, but that should be your last option. You're too rich for federal student loans. We hear that one a lot. No, actually, you file a FAFSA, and there's a large percentage of families that just don't file because they don't think they can get anything. The federal student loans are just that, they're loans, and most people can get those. There's no caps on income. Now, for grants and those kind of things, yes, that's different because that's based off of need, but really the federal student loans are just that, they're loans. So there's not really any true caps on there. 14, paying your mortgage each month will do wonders for your credit score. Well, you definitely want to pay your mortgage every month. FICO and all the other credit scoring algorithms expect that, right? So just by doing that, it's not going to increase your credit score. By not paying it on time, it's going to have a negative effect. That's just standard practice. Then the last one there, 15, a late credit card payment will damage your credit. Yeah, late payments are not good. And I hesitate to say this a little bit, but typically what happens is if you're late, you're going to get a late fee that you're going to have to pay to your creditor. The creditor typically does not report you as late until it's 30 days past, right? So yes, they're not good at all. That credit, it could affect you doing future business with that creditor. You definitely want to stay away from 30 days past because that starts taking ticks on your credit report. Okay, so there's more information in these myths, and like I said, I'll post this document. Let's go down to the credit health. I'm not going to read through all this. You guys can read this on the when I post it. But there's a lot of different scoring algorithms out there. There's three, main agencies. You have Equifax, you got Experian, and you got TransUnion. They each have their own models and scoring and the way they come about it, but they're usually pretty close. You definitely want to check all your credit reports on an annual basis, at least. You can do it more, but to just check for inaccuracies and misinformation, you want to make sure that the accounts listed are correct, that your primary information is correct, name, address, social, other names, whatnot. Make sure that it's correct. If you find incorrect information out there, you can file a form with each credit bureau to make corrections. Crazy enough, over the last year or two, the average score has reached almost an all-time high at 711. The scale is between 300 and 850. And we're going to talk about that here and what affects that. So let's dive into that. Factors of credit score. All right. There is a ton of different factors that go into the credit score, but let's talk about the top ones. Okay. Again, 300 to 850 is your score, is your scale. Typically, a score more than 650 is considered fair, more than 700 is considered good, and 750 is considered excellent. If you look at the factors, excuse me, that make up your credit, let's go around in percentage order here. Your payment history, as you can see, is the biggest chunk. 35% of that algorithm or the model to come up with your score is from your payment history. Making late payments is the first thing and the easiest way to destroy your credit, is your payment history. Into that payment history, though, it looks back a number of years. So you can overcome that, like we said, back from the bankruptcy, but it's going to take 7 to 10 years. Payment history is critical. Amounts owed, 30%. That's the next thing. If your credit ratio, if your ratios are out of whack, then that's going to affect it as well. What I mean by that is if you have a $5,000 credit limit on a credit card and you have $4,000 as a balance, that's a hit because you're utilizing all your credit. They see that as a risk. They see that as you're not managing money as well, and they see that as you're living a little bit tighter. Generally, to not affect your score or to improve your score, you want that balance to available credit ratio to be 20% or below. That will positively affect your credit. That's that amount owed section. Also, the total combined open credit, that affects your credit score as well. That's all kind of combined in that amount owed section, right? Length of credit history. We talked about this, about leaving your old credit cards open. Do you want to choose the right ones? I want you to get down to one. Choose your oldest one that's going to make the best effect on your credit. So length of credit history. That's one thing, is the age of the cards or age of the accounts. The other thing is if you're younger and you're new and you're just getting started out, obviously you don't have a lot of credit. So as you mature through your financial stages of life, your credit score will increase naturally just by having credit that's been open for a while, whether you have a mortgage or whatnot, and it's starting to age. The other thing is new credit that is affecting your credit score. They look at how many new credit cards you're opening. So that's kind of a negative effect there, right? If you don't have a bunch of new credit open, that's a plus. If you're opening up new credit on a regular basis, that definitely has a tick back on your credit. So be careful about if you're just switching credit cards around, paying one off with the other to try to get a better rate. It will catch up and have a negative effect on your credit. And then the type of credits in use. That type of credit is one thing I was referring to earlier. They look at whether it's a mortgage, a car payment, a student loan. Is it a retail loan, a retail credit card? Is it a major credit card? Like from a major bank. Different types of credit affect your credit score differently. Personal loans affect you worse than the credit cards. You can scroll down then after I post this. You can scroll down through this and it tells you a little bit about each of these. So the payment history, 35%. It talks a little bit more detail about each of those. Amount owes, it talks about that credit utilization. That's what I just talked about being the 20% or lower. It talks a little bit about that. And there are some other links in here too that you can look at. Length of your credit history. Again, we talked about the length of how old your accounts are, and your new credit, or 10% there, and the types of credit in use. Remember, I talked about installment loans. That affects you different than mortgages. So those are the 5 main types that affect your credit. All right, those are the top 5. They're not the only 5, but it's the top 5. All right, so what isn't in your credit score? Things like marital status, age, race, salary, occupation, where you live, all those kind of things. It's in your credit report, but that does not affect your score. The only thing that affects your score are those top 5 things, as well as other things. It's all the hard data, financial, money aspects. Things like how much you make, marital status, age, where you live, how many kids you have, all that kind of stuff has no impact on your credit score whatsoever. But it is on your credit report as a public record, and lenders help use that to make sure you are who you are, and marry up information. All right, so let's continue down here a little bit. Can service accounts impact my credit score? So what we mean by that is like utilities and phone bills. Traditionally in the past, those kind of accounts didn't affect your credit. They're starting to make ways to make that help your credit out a little bit. All the different agencies now have programs and ways for you to have your utility bills, your Netflix bills, your phone bills, and all this kind of stuff have an effect on your credit. So if you're trying to improve your credit and all those things are in good standing for you, you can sign up for different programs with the credit agencies so that will start accounting for in your credit score. Down the road, they may start accounting for those things just naturally and inherently, but for now you have to sign up for those. One of the things I'll mention here, because we're one of the first ones out to really publicize it, is Experian Boost. You may have seen commercials for it. You can sign up for that. You have to sign up, log in, and connect all your different things so they can see your payment history, and that can actually give you a score. But if you're paying on time on your utilities and all those things, it can actually boost your score because they'll factor that in to their algorithm. But you have to sign up for that. That's not by default. All right, let's talk real quick about what can hurt your credit score. It kind of goes back to the other 5 things that we just talked about. Missing payments. Number one thing that's going to affect your credit score is missing payments. Using too much available credit. That's the utilization factor that we just talked about. You want to make sure utilization factor is low enough so they don't see that as a risk. Applying for a lot of credit in a short period of time. So there's kind of 2 things there: applying for a lot of credit and the duration. Now, if you go out and shop mortgages or shop car payments, that doesn't hurt you because they see it's the same type of credit pool. in a short period of time, like within a matter of days. They'll consider that one. But if you're going out and you're trying to get different credit cards and it's, over a course of a month or two, you're opening up all these different accounts, that's definitely going to affect your credit score. And then all out default on accounts obviously is going to affect your score. All right, so there's the negatives, but how are we going to improve our credit score? Really, the basic concepts of improving your credit score, like I said earlier, there's no magic wand, there's no easy button. It's paying things on time, you managing your utilization percentage that we talked about, and just keeping up with your credit, paying down your debt, and being responsible, being that good steward. Highly recommend you going out and monitoring it. You can go to freecreditreport.com. All three agencies have the reports out there. You can go to each agency individually and request a report. You can go to each of their websites individually, but you can go to freecreditreport.com, and all three of them kind of cooperate on that one. So here you go. Pay your bills on time, pay down debt, make outstanding payments, things that are past due. Dispute inaccurate information on your credit reports. Mistakes happen. Lenders file the wrong things, report the wrong things. That's why you want to check your report at least yearly. And like I said, pulling those credit reports on your own does not affect your credit. And limit your new credit requests. Be smart about when you take out credit if you have to. Obviously, we want to be financially responsible. We want you to limit how many times you take out credit and reduce that, but you got to be smart about it. Shop around, think about what your true needs are before you start applying. And that's really, kind of for mortgages and car loans. Hopefully, we're going to get you down to that one credit card. This is just starts talking about why lenders look at your debt. And some of the miscellaneous things there, and then some sources down there. So guys, that's it for the credit health. I'm going to post this out there for you guys. Please hit me up with any questions, whether it's on the debt side, whether it's on the credit side. If you found this information valuable and you need me to help you with things, hit me up. I'm more than happy to work with you. And so next week we'll continue on. We'll probably start talking about that grow section. So we're going to go into talking about emergency funds and what does that mean, how to do it, best ways to do that, and the most effective ways to do that. And then as we go through, probably the week after that, we'll start getting into some more of those 9 core biblical principles and go back to some Bible verses, and then we'll jazz back into and start getting into some stuff that excites me around investments and things like that. So we have a long way to go. We got a lot of things to cover. Again, appreciate your time. Hit me up with a hashtag replay if you're watching a replay, hashtag live if you're watching it live. I appreciate that. Appreciate your time. Email me, DM me, message me, whatever. If you have questions, I'm here for you. Happy to help, and look forward to next week. Y'all have a great evening.